This lecture is intended for Economics 136 at Harvey Mudd in the spring of 2020. This is the first of a series of lectures about trading futures contracts, including trading futures contracts with models. In this lecture, we're going to remind ourselves of the fundamentals of futures contracts, and only that. You should already have a deep knowledge of futures, or at least how they work, because that was a prerequisite for being in this class. If you want to review the subject because you don't remember it, then go back to the online book used in Econ 104 and read Chapter 10 again, and the link is right here. Or review those lectures about futures contracts from Econ 104, which are linked down here at the bottom. Now, I'm going to assume that you may have forgotten a little bit about how settlement works and how margins work, so at least we're going to review that material today. A futures contract allows a trader to undertake a contract to accept or make delivery of a commodity or some kind of financial asset in the future on a known date or range of dates under specified conditions for a price contracted today, at least implicitly. The party to the contract who is agreeing to take delivery of the commodity is long in the position, whereas the party who is agreeing to deliver the commodity is short in the position. A speculator will benefit when she is long if the prices rise, short if the price falls. Through submission of bids and asks, the exchange will match long orders with short orders, either with an outside trader or with their own trades. Now, you need to understand the symbols for futures contracts. They consist of three components. The first is the product code, which is either 2 or 3 elements. And you can see the common contract symbols on the little chart on the left side. Crude oil at the top is C oil, CL. Crude oil E-mini, and I'll explain that in just a minute, is QM. And going on down, you can see the standard range of commodities and financial assets represented: Bitcoin and wheat and corn, gold, silver, the indexes like the giant S&P 500 contract, SPX, E-minis and micro-E-minis of the same. I have those in green because they deserve special attention, which we'll cover next. And the various FX contracts like the Euro US dollar, the Euro FX, and so forth. So you have to know or find the symbol, which is on the CBOE website and also typically on your broker site. It's usually 2 elements like NG for natural gas, or 3 if it's a micro contract, such as MGC for gold. Then the month is determined by the month symbols that is used by the CBOE, which typically doesn't make a lot of sense to people, except that they're in order, but they tried to figure out non-conflicting signals. They can't use the first letter of the month because January, July, and June all have the same letter. Certain letters they excluded because they're confusing, like O and I and so forth. So this is what you're left with. January's F down to October's V and so forth. So it's also the practice for many of the brokers, and that's certainly the case, interactive brokers, that the year they represent with a single digit. Although I do see some quotations from other sites that use double digits. So since this is May 2020, then the appropriate symbol for this contract is NGK, K being for May, and 0 being for the last digit of 2020. It may elsewhere be represented as NGK20. Now, I do want to talk a little bit about the roles played by the E-mini and the micro-E-mini contracts, because these are relatively new, and these do allow the smaller retail trader to get in on the action. To be sure, I trade these quite a bit. I'm in one right now for oil as I'm making this lecture. So, as I say here, the CBOE in recent years have introduced smaller versions of their traditional popular contracts, like those shown below for SPX, SPX being the gigantic, expensive S&P 500 contract that's been around forever. That contract is equal to $250 times the index, and so the notional value of that contract is high. But you'll see the E-mini, for example, is worth only 50 times the value of the contract, and the tiny MicroEmini is worth 5 times the value of the contract. So MicroEmini means 1/10 the size of the E-mini, as you can see here by this one example. Now currently MicroEmini is offered for 4 contracts, all indexes: the S&P 500, the NASDAQ 100, the Russell 2000, and the Dow Jones Industrial Average. Of those 4, the only super contract that's traded is SPX. The NASDAQ, the Russell, and the Dow all have micro contracts, but they don't have the main contract. These contracts, especially the MicroEmini, are popular with small traders for obvious reasons. The cash required to get started is lower because they have lower margin requirements, which we're going to talk about next, and they are cash settled, which is very important. Cash settled means that there is no commodity delivery that is required if you're still holding the contract when it expires. So the previous definition that I had was a traditional definition that would be true for oil or natural gas or even SPX, where you're required actually to deliver a commodity or a market basket of stocks in the past. But for the MicroEmini and the E-mini contracts, the contract just terminates on its last trading day and there are no delivery conditions, which is far more suitable for a small trader. And we'll elaborate on that a little bit more. It is the case that bid-ask spreads on the MicroEmini are a little wider than I like, but not on oil. And they're not ridiculous on the indexes. They're just quite a bit wider than, they imply quite a bit of a swing in the price of the index itself between bid and ask. And so they are criticized for that, but I don't think that's much of a problem. Although they're wide, you can overcome them if you are making fairly good directional bets or using them for hedges. In addition to the S&P 500, the E-mini, and the micro that I've already explained here, we also, by another example, are looking at the WTI crude oil contract, which has the symbol CL. That contract has a multiplier of 1,000 barrels, and the contract I trade, which is a WTI crude E-mini, which is QM in the symbol, is for 500 contracts. And again, the large crude oil contract requires delivery, and we'll explain that in a minute. But the small E-mini, half the size, is a cash settled contract, which means on the last day of settlement at exactly, I think it's 2:30, that slide's a little bit ahead of us, it just stops trading on behalf of settlement and you're done. And so that's suitable for the small trader. Now, when I type point or penny impact, you always should know what change in your cash will be affected by a 1 point or 1 penny move in the contract in question. Now, in the case of an index, it's the point difference. So if the S&P 500, the index itself, rises by, I shouldn't say it that way, if the S&P 500 futures contract rises by 1 point, then the impact upon your account will be $250, a loss or a gain, depending upon whether you had the bet right or wrong. On the E-mini, it's 50, and of course on the tiny MicroEmini, it's only 5. In crude oil, which is priced per dollar per barrel, then a 1 penny increase in the crude oil or change in the crude oil will impact your account to the tune of $10. And for the smaller account, it will impact your account to the tune of $5. And so before you ever trade a futures contract, you really need to evaluate the point or penny impact so you can understand the sensitivity of that futures contract to the sort of price swings that you've been seeing lately in that contract. These things can swing in price a lot more than some people realize. And I'll give you an example right here. This is what all of this looks like on a brokerage site. And this was taken off of Interactive Brokers for one of my accounts on March the 23rd. This, in fact, is the account that you see in Econ 136. So if you look over on the left side, you see a series of quotes. You also see the spread between bid and ask. So at the top we have natural gas, various kinds. One of those is an E-mini. Then we have the index futures, SPX, and the micro and the like. We have the micro and the MicroEmini, then gold, then the specific MicroEmini because I trade those. And then, of course, the FX contracts that I sometimes trade, and the two oil contracts, the big one CL and the small one QM. Now, if you take a look at the spread between bid and ask, for example, on the oil contracts, you can see on the big contract it's about 2 cents, but it's not much different on the small contract, the one that I'm currently in, as you can see up here on the on this little position indicator in the middle of the right side of the page, where you have that long oval circling QM May 29X. That's actually a long position that I'm in. That contract spread is barely wider than the contract spread on oil, on the big contracts. So there, it's not really much of a problem. If you look back up at the MicroEmini contracts, you can see the spread on the one listed on the top, the June 19th, is about 75 cents. And that's likely to be less than the spread on the SPX itself, which is, well, let's see. In this case, actually, it's not. So, oh no, let's see, I'm looking at the wrong con. SPX is on the bottom. In that case, yeah, it's 30 cents. So the spread isn't really all that much different. So the spread criticism that you often hear may not be all that justified for at least these contracts. What we're showing here on the right is how you enter orders. It's just like buying a stock or just like buying an option. You have the buy-sell combination on the top order entry there. You have all these devices for specifying your limit order range or price or whatever you want to do. And this is, of course, for doing the contract manually. And then, of course, when you take a look at the portfolio, this portfolio is one we use for trading in class, so it doesn't have anything in it except this oil contract and the gold position right now. And you see we're down on the oil contract by about $2,300. This morning we're down about $1,900 on it. So not all of our trades are brilliant. I think that we actually will make a profit on this contract, and the loss is not as great as this number indicates because I actually had the April contract that I had to roll into the May. And when I rolled it, the April contract was up $680, I think. So the loss is $2,352 minus $680. But you can see how volatile the QM contract is down there in the bottom. And you can see that I'm looking at 3 days here on 30-minute candles, and the swing has been between 21 and about 26. And so if you calculate the penny value of one of those contracts, then you realize these contracts will rise and fall in value $2 or $3,000 every day. So futures contract can be, futures trading can be pretty wild at times. Okay, here's some advice from me to you if you're a student in the class. I know that a lot of you trade options. I know that you use Robinhood or did use Robinhood for trading stocks and options. But I honestly advise you, if you really want to cut your teeth on an interesting market, that you take a look at futures, get used to it, and start trading at least some of the key contracts that are a little easier to understand, specifically the index contracts, because they offer the MicroEmini scale, and you can experiment with your strategies without losing too much money, even if it goes against you. As I write here, if you are the kind of trader who wants to experiment with directional swing bets, mean reversion models, or technical models, especially if you want to experiment with indexes like SPX and DIJ, rather than use stocks or ETFs like SPY and DIA, you might benefit from using futures contracts instead. The markets are extremely liquid, are open more hours, essentially 23 hours a day, 6 days a week, have options available if you want to trade options. Options on futures are similar to options on ETFs. They offer leverage to a substantial degree, and futures lend themselves well to computer-assisted trading. Unlike stocks, shorts are just as easy as longs, so there's no problem with shorts. And they don't have premiums that expire like options do. A bearish directional bet is trivial to make. You just go short in it instead of long, and there's no distinction between the two. You either start with the buy and end with the sell, or you start with the sell or end with the buy. And by that I mean, if we go back to the previous slide right here, see on the order entry up there we have buy and sell. If you're going to go short, you start with the sell. I have a sell here, but I'm already in position. I have this option, and I didn't sell it. I had this up so I could show you how it works. If you're already long in the position and you choose sell, then you're sold out of your position. If you're not in position and you choose sell, then you're short in the contract. That's how easy it actually works. A good contract in which to practice or develop mean reversion or technical modeling is the S&P 500 MicroEmini contract, MES. And so MES for June would be with 2 additional characters added, which has notional value equal to 5 times the index rather than 250 times the index of the monster SPX parent contract. Or with the WTI West Texas Intermediate crude oil E-mini QM, which trades at 500 barrels rather than the parent contract, which trades at 1,000 barrels. Directional bets are easy to place on SPX or MES, and your option models will work just as well as on future options as on stock options. And if you're an international student, you might actually have the knowledge to trade FX futures like the E-mini Euro, E7M, and the E-mini Yen, 6EM, and I have traded recently the E-mini Pound quite a bit, which is actually fairly easy to trade. When you are using a broker, you will be able to bring up contract specs and trading hours always. You can click on something that brings it up. So this is the interactive broker interface this is a pop-up for the light sweet crude oil E-mini contract. So you can see there that the symbol of that contract in particular is QMK0, as we said before. The trading class is QM and the like. It also has the all-important trading hours, and it has the margin requirements, which we are going to discuss here in just a minute. Now, the trading hours for most futures, it does vary a little bit, is Sunday through Friday from 6 p.m. New York time to 5 p.m., meaning, in other words, it's closed from 5 until 6. And on Monday and Friday, there's a trading break from 3:15 to 3:30 p.m. for most contracts. Not all contracts. Some of them have a trading break from 4:15 to 4:30, from what I understand. And so you always have to look and see where your option ceases to trade. Now, that, of course, means that you have a market that's trading around the clock. Now, you've probably seen the full option chain for contracts before because we looked at a lot of them in Econ 104. We were trying to, for example, consider the definition of a contango. This is a contango market, if you remember what that is, because the May 2020, this I think was from the 23rd or just before that, the May 2020 is priced at 23.27, and the February 2021 is priced at 32.55. That's a contango market. We'll talk about what that implies for trading strategies in a future slide set in this series. This is the large contract. More months are included than are shown here, including monthly from March 2021 to 2031 February. There's a contract for every month going out that far, but all contracts after December 2024 are illiquid right now, and illiquid always when they're that far out. And only June and December contracts are liquid after January 2022. I don't know why the convention is to have those two contracts being the contracts in which they're traded, but that is the convention. The closer the expiry, the more liquid the contracts are. Contracts going out a year, typically for these kind of contracts, are tradable, no matter what you're talking about. All right, let's move to an important subject that you absolutely have to understand if you expect to ever trade options. And that's margin requirements and what they are and why they exist. Now, this is important. When you go long or short in a futures contract, you're not buying a financial asset like you are when you buy an option or sell an option, you're selling one in that case, or buy stock or shorting stock. You're not buying a financial asset nor an underlying commodity like crude oil or natural gas. You're simply entering into a settlement contract that might allow you to buy an underlying commodity or similar at some time in the future, at a known time in the future, at a favorable price. Because you're not buying a financial asset, the cash in your account balance does not decline when you initiate a trade, except for the tiny transaction fee, like the $1.20 it took to buy the contract. So the balance of the cash does not change. Or to put it in other words, no cash is debited from nor credited to your account when you enter a contract. And the same thing holds true when you exit the contract, which is typically called the offset. For this reason, both the exchange and your broker require you to set aside a minimum amount of cash for each contract, which remains in your cash account, but is earmarked and not available for use elsewhere. And I'll show you an example of this in just a minute if you don't really understand the language here. The cash requirement when you enter the contract, whether long or short, is called the initial margin. As the account value fluctuates over time, the minimum cash balance allowed for your account is called the maintenance margin or day margin. Now let's take a look at these comments we have to say by example to make sure we understand these terms. Let's be systematic about this. The initial margin is the amount of cash per contract that you must have in your account prior to trading. So for example, on the day I recorded this, that's $5,600 for the CL crude oil contract. That changes, by the way, very fast, can change even daily, so you have to look it up, although of course your broker always provides it for you. The maintenance margin is the amount of cash per if the amount of cash per contract falls below this value, you will get a margin call and you must replenish your cash balance. So in the case of the CL contract, if the cash per contract falls below $5,040 per contract, you'll get a margin call. There have been a lot of margin calls lately in these markets because of the severe volatility of the markets, and that has caused problems for some traders. The notional value of the contract, which we must understand to calculate settlement, is the contract size times the price. So it changes at every moment because the price changes at every moment, at least during market hours, and that's 23 hours a day. So if the price of crude, for example, is $23.27, there's 1,000 barrels, that's $23.27 per barrel. It's 1,000 barrels, and that's equal, therefore, to $23,270, and that is the notional value of the futures contract. Implicit leverage, which you can calculate, is the notional value of the contract divided by the amount of cash dedicated to the trade of that contract by you. Now, I used to list this as the notional value of the contract divided by the initial margin, but nobody actually runs cash that low in the account. You have to run cash in the account higher than that, or you're even required to run cash in the account higher than that if you're a small trader. So implicit leverage captures the sense that you realize you have to have some cash set aside for trading this account. So the implicit leverage is equal to the notional value of the contract divided by that cash amount. So if you have $10,000 set aside to trade this large CL contract, then your implicit leverage in that trade is 2.33 to 1. And then finally, as I said before, the penny impact, or I sometimes call it the penny and point impact, each penny move in the price of oil, so we're talking about oil here, so it's the penny impact. Each penny move in the price of oil affects the margin account by $10,000, not $10,000, $10 per contract. You always want to know the penny impact when trading futures. So in other words, if the price of oil goes up or down by 1 penny, it'll affect the cash account by $10 for the large contract. It'll affect the cash account for my contract that I trade, the E-mini, by $5 per contract. Before you go into the contract, you need to know that. Now, we still need to understand a little bit more about margins and leverage and precisely what they are. So we will go to the CL crude contract to get an example of what you need to know about it. Again, before you trade futures, they're actually in some respects more complicated in major respects than stocks or options, but the trading is simpler. So the concept behind them, what is a futures contract, I think is kind of hard for students to digest when they first hear about them, but the trading I find to be considerably more simple compared to options especially, because options have the premiums and time decay and all of that, and futures contracts don't have time decay and premiums. So let's systematically go through what you need to know about the CL crude contract. First of all, you need to know the contract size. For crude oil, it's 1,000 barrels or 42,000 gallons of crude oil. Remember, for the giant SPX contract, it's $250 times the value of the index. So you always need to know the contract size. You need to know how it's priced, dollar per barrel or pennies per gram or whatever. Obviously, that is self-evident. You certainly need to know the initial margin requirement, because we have already said that that's the amount of cash you have to start with to initiate the trade. And if you're a smaller trader, you need to remember something. Although they charge for the crude oil contract on the day that I looked this up, which was I think 2 days before today, $5,600 cash has to be in the account per contract. The requirement for the smaller trader, like at Interactive Brokers, is at times especially much higher than that. The effective brokerage margin for a small trader actually equals 50% of the notional value of the contract. So you're basically trading on margin. And I think they do that because they need to eliminate excessive speculation by people who don't know what they're doing. And there has been a little bit of that lately. The maintenance margin, again, is the amount you have to maintain in your account once the trading starts. And for the CL contract, that's $5,040, or was at the time I looked this up. Again, it can change at any time. You need to know for certain for this contract, because this is a deliverable contract. You do not want to be in this contract, long or short, if you're a small trader, when it expires. So not only do you need to know the last trading date, you actually need to know the last trading moment of that date that is allowed before you offset your contract. Now recently I was actually stuck in the April contract because I didn't realize the trading day was approaching. I thought it was the following week, and I was surprised to see my contract stop trading. Fortunately, it had rolled already into the May contract. And so it just wasn't there anymore, and it was settled based upon the settlement that happened at the under settlement conditions that are actually fairly complicated. The last trading date and moment is 2:30 p.m. New York time on the third business day prior to the 25th day of the month prior to the contract month. So that's a lot, but all that's saying is for a June delivery, the last trading date is going to be in May, and in May it's going to be on the third business day prior to the 25th of May, and that turns out to be May 22nd for the June 2020 contract. Turned out for the April contract, the 25th of the month was on a Tuesday or something like that, so it pushed it pretty early into the previous week because it's the third business day, not the third calendar day. Again, this is critical to know if you're a deliverable, because if you have to deliver, then you have to deliver. If you say, I can't deliver, I'm a college student, I'm long in CL for 1,000 barrels of crude oil, are they going to deliver 1,000 barrels of crude oil to my dorm room? And the answer is no, they're not going to deliver it to your dorm room. You're going to get a really nasty email from your broker, maybe even suspending your account for making such a mistake. This won't happen, of course, if you're trading the E-mini. The delivery location, in fact, is very specific for crude oil. It has to be delivered to locations in Cushing, Oklahoma, or pipeline access that goes to Cushing, Oklahoma, such as TEPCO or Equilon Pipeline Company. So you say, well, who would that be? And of course, those are major oil companies. So even though you can trade in the CL contract, you really can't participate in delivery unless you have access to the TEPCO pipeline, which I doubt you actually have. Now, what about the CL crude contract, the little one? I'm not going to go through it one by one because it's similar, but the contract size is 1,000 barrels. No, that's not correct. This slide is incorrect. It should say 500 barrels. I actually changed that. Oh no, I'm sorry. This is a summary of the CL crude contract. This is not the E-mini. Sorry. So this is what I've just said. Contract size you need to know, pricing of the quote, the initial margin, the maintenance margin, the last trading day and the last trading time allowed when it closes off, the delivery date or the period or the delivery location. Now let's look at the E-mini contract and see how it differs, and that is arranged as all in one page. I won't roll down through it. So the contract size is half, 500 barrels, 21,000 gallons. The initial margin, as you can see, is also small, but again, the effective broker margin for the small trader equals 50% of the notional value of the contract, so that limits your leverage to 2 to 1. That's on purpose, obviously. The maintenance is 25/20 officially, and the last trading day is the same, but the delivery date and period, none, because this is what is called a financially settled or cash contract where settlement just stops when it reaches the end of the last trading day. There's no delivery condition. Although final price determination is complicated if you hold the option until after its expiry. You do tend to want to offset before that happens. I made a rough calculation that I probably lost about $200 on that contract that I let expire when I took a look at how the settlement price was arrived at a little bit later in the day. So you don't want to let these things expire intentionally, even though there is no delivery date. Now, when I talk about the broker initial and maintenance margin for small traders, you can see the difference here. Take a look down there at QM on the CBOE, and you can see that they actually have a different margin for each contract, 2,800 for the, I don't know if that's got to be the May contract, and then 2,775 for the June contract, 2,662 for the July contract, but we're in the May contract, and the interactive broker's margin for that is not $2,800. It's initial margin of $5,180, and the intraday margin, the maintenance margin, or the day margin, $4,144. That's a lot higher than the minimum required by the CBOE. So the individual brokers have a policy typically, especially at times like this, that bumps up these margins considerably when, well, most of the time, I think. I don't trade oil very much, so I don't know if the margin is this high all of the time. The margins on the foreign exchange trading I was doing, though, was nowhere near this when that market was fairly quiet. That was the British pound a few months back. Anyway, if you're a small trader, you're not going to be able to get the leverage out of your trades that a professional trader or seat exchange trader. But you still get leverage, and it's easy to practice on these smaller contracts. Now, everything is settlement. If you've taken Econ 104 from me, this is what I stress. If you don't understand how settlement works, there's no way you should be trading futures contracts. It's very different than options or stock sales. Unlike options, futures are not paid for, as we've already said, which is to say the commodity to be delivered is not paid for until the delivery of the commodity, in the case of crude oil, or they are cash settled without delivery, in the case of the E-mini crude oil. The buyer of the future, however, is required to maintain funds in a cash account, which at the end of the day is adjusted to reflect the capital gain or capital loss for that day. The starting required balance for this is called the initial margin, as we already know. We saw what it is for the two oil contracts. The account balance must always be kept above the maintenance margin, which is sometimes called the day margin. Now, even though for years and years I've written out that the settlement is at the end of the day, and it technically actually still is, most brokers now do dynamic settlement on your account, which is to say periodically throughout the day, they upgrade the cash account or downgrade the cash account based upon your position as it goes through the day. It's not continuous, at least not at Interactive Brokers. In fact, I've never quite figured out the timing on it exactly. It seems to be about every 15 minutes or so that they update it. So all they're doing, though, is sort of keeping tabs on the inevitable end-of-day settlement, which is technically how it's still supposed to be done for futures contracts. But you'll see, if you're in a futures contracts, that your cash balance is going up and down all day long, and it's reflecting discretely, not continuously, those changes in the notional value of your contracts because the price is changing. Here's an example of that for the same contract that I was talking about. This is the QM May 20, which is the E-mini oil contract. And so at 11:53 a.m. on the 24th of March, the cash in the account shown here on the top is $42,238. Now, the gold listing there is an ETF. That's something you paid for, and so the value of the account is not affected by that going up or down. But the futures contract, on the other hand, you can see is a certain value. Then you go back some about 10 minutes or so later, and you see the account balance has changed even though no transactions have taken place. Now again, the updating of the cash value is not continuous, it's discrete. It's done periodically rather than continuously. So the realized gains and losses don't match the cash change in these slides. To get them to match, I would have to capture them at the exact moment of the cash update, which was not done here. That's too much work. So you do actually have a sort of dynamic settlement throughout the day. Your cash is going up and down as your fortune wanes to and fro on the basis of your futures contract. And we have to remind ourselves that we're looking at a market that is open 23 hours a day. It doesn't shut down at 1:30 in New York time like the stock market does. I don't know if you can see this here, but this is a quotation chart for QM May 20, the same contract. And there's actually a midnight line that can barely be seen there. And so the space between the dotted line to the left of the midnight line and the midnight line was what normally we would consider after hours for the stock market. This, of course, actually justifies the use of algos to trade futures because you can't be looking at this 23 hours a day. And others use stop orders, but I really don't like stop orders for reasons I've already explained in the class. I don't think stop orders or stop limit orders are really all that suitable. You can perhaps have a watch that notifies you when a certain price has been penetrated, but it's far better to have your account monitored by an algo that is constantly probing to see what the bid-ask spread is on your futures contract, and you can tell that algo when to buy or sell, and it doesn't have to be on a crude price calculation. It could be based upon some formula that you've applied to the algo for doing that. There does appear at times to be a lot of mean reversion property in the futures markets, especially in oil. It does trend a lot, and the mean reversion breaks after a while, but you see up, down, pretty routinely. So it might be an interesting area to experiment with short-term mean reversion trading strategies. And to have an algo do that rather than for you to sit there and stare at it at 11 o'clock at night makes a considerable amount of sense. Now, in case you still don't quite understand the example of the margin account, let's use this made-up example to see how the margin account is affected by your trades, all right? And so this is an older example that I used. I think I drew it up for Econ 104 this last year. I change it from time to time. This was when oil was more realistically around $56, $57 a barrel. And so I don't want to have to make this slide up every time the price of oil changes, so I use this as an example. So let's say we want to go long on the standard CL contract, which you know is 1,000 barrels. So, and of course that means if we're going long, that if the price rises, we're rewarded. If the price falls, we pay the penalty. So let's go through this systematically. First of all, this is the cash in our account before we start the trade. And that's what we're trying to monitor, the cash in the account. So we're saying that's $5,000. Normally it would be more like $10,000, and perhaps I should change the example to reflect that. But so far, this is what we're using as the example. Let's say we go long on the contract, not really buy the contract in the middle of the first day. And so we do this at 56.74, and it does not affect the cash value of the contract, as we've already said. This is our cash position after the trade. Notice that cash is unaffected by starting our long position, and that's the way it works. We're not buying a contract. Settlement is beginning, but we're not buying a contract, and so the cash does not go down, except by a small transactions fee, like $1.20, and I'm not showing that, obviously. Now, our first settlement will be at the end of that same day. At the end of the day, the settlement is made that reflects the difference between the price of oil when we entered the contract and the closing settlement price. So the price when we entered the contract was $56.74. At the end of the same day, the settlement price is established as $56.52, and so the small loss there, because we're long, of 220, therefore the cash in the account is either then or throughout the day has been reduced so that your cash is down to $47.80. So this is the opposite of options and stocks. When you buy a stock or you buy an option, the cash goes down by the amount of the purchase. Thereafter does not change until you offset. In this, it's exactly the opposite. Cash does not go down on the entry or the exit, but it changes all during the time you're in the position. The exact opposite. That's what's so important to understand about futures contracts. Now, and so forth each day. Now, see what is determining settlement? This is why we went to the trouble of defining notional value. Notional value, remember, is the price of the contract at any given moment times the size of the contract, which for oil is 1,000 shares. So this position has a notional value at the end of day 2 of $56,480 because the price is $56.48. Now that is a $40 loss compared to the end of the day before, $56.52 to $56.48, and so the cash balance is settled down from $4,780 to $4,740. So this process goes on every day until you offset or exit the contract. Any increase in the price results in cash being added to the cash account, and any decrease, as is shown here, results in cash being subtracted from the cash account. Now, in this case, if we assume that the maintenance margin was $4,000, having it drop to $32.80 because the price of oil fell to $55.02 would generate a margin call because we have gone below the day margin or the maintenance margin, right? So the maintenance margin is the minimum balance of cash dedicated to this account that has to be in place before we ever start this. If we fall below that, then you get a margin call. I don't show that in this example. We're just going to ignore it for the time being. And so finally, on the 6th day, we decide to sell out of our contract because we got the pop in price that we were hoping for. It went to $57.02. So we offset or exit, those terms are interchangeable, our contract on the 6th day, and we do it in the morning. So final settlement is calculated based upon the exit price, obviously not the end of day price, and we are done. So if we exit before the expiry, which is going to be the case for everybody except oil dealers, then it's over. Now you can see the cash account has changed. It's changed because of this daily settlement. So that, I think, should make it clear that how settlement works. And this is true for all commodities, whether they're deliverable or not. So if you don't understand this, go back and take a look at the slide set, which will be posted link probably from the video, or certainly link from the class website. It may not be when this is posted up because I'm modifying these slides as I go, so it may come up a few days later. You can go back and look at this and make sure you can figure it out. This, of course, is exam question territory galore. Now, how do you pay for delivery? This is a little bit complicated too. As often as not, you don't, because everyone's trading these smaller contracts with no delivery. But if you do go long on a futures contract for $57, such as $57 per barrel of oil, if you take delivery, you will end up paying $57 for the commodity. But it's a little subtle as to how that happens. That net cost will consist of two components. One, the price you pay at delivery, which is actually spot for that day, the same as everyone else. You're not given a special price of any kind. You don't have a contract to actually accept the oil for, say, $57 instead of $59. But also the result of the daily adjustment to your margin account, whether a capital gain or capital loss. So therefore, you pay the spot price, whatever it happens to be on that day. But meanwhile, your margin account has had its cash value changed. And so if you made a profit in that margin account, you subtract that from a higher oil price. No matter what you do, whether the price went up or down, the effective cost, which consists of these two components, the spot price adjusted for the cash account delta, means effectively you are paying $57 because of the adjustment in your margin account. So the final thing you have to take into account is that if you're in a $57 long contract, this does not entitle you to buy oil at the spot price of $57 when it comes time for delivery. You pay the spot for that day just like everyone, including those who were never in a futures contract. It's the change in your cash account due to settlement that allows you to adjust the effective price to $57. And a lot of people kind of forget that too. Okay, let's take a look at 4 takeaways that you must understand. And of course, any quiz question is going to be based upon this. This is sort of an overview. Your margin position is determined by the free cash in your account. There's not a special account for margin. So as I showed you back on my account, there was only one cash account, the one that had a $42,000 balance in it. There's not an account for margin and an account for cash for other purposes. It's all in one account. But it is earmarked, part of it, for margin if you have a futures contract. So it's locked up. You can't use it. 2, when you enter a trade long or short, it does not increase or lower the cash in your account, as we've already emphasized. When you go long or short in a futures contract, you have not yet acquired an asset. You have initiated a contract to eventually acquire or dispose of an asset, the underlying commodity. And that even is only for the traditional contracts that have delivery. In the cash settled contract, you have only agreed to start the process of settlement. So effectively, being in a futures contract is a statement, I want to start settlement now. And when you offset, you're saying, I want to end settlement now. And that's it. That's the only thing that's going on actually in the contract, especially for the cash settled contracts. As the price of the underlying goes up and down, the cash in your account changes to reflect the new notional value, either at the end of the day or dynamically throughout the day. And finally, when you exit a trade long or short, it does not increase nor lower the cash in your account, except, of course, for the final cash adjustment for that day, which will depend upon the price at which you exited compared to the settled price from the night before. So these are the 4 things that you want to remember about these futures accounts. If you understand this completely, then you should now understand the complex strategies we're going to talk about trading futures. That's it for this. So the next time we see each other will be when we start moving into strategy discussions and such things as contangos.